In this video we are going to talk about 10 dividend stocks to buy right now. So before starting, please like this video and subscribe to this channel for our future updates. Don't just go for the best potential return when buying dividend investments these days. Making a decision based on present income, as well as future development opportunities, is critical. By investing in these 10 dividend stocks to buy right now, you can develop a lucrative income portfolio. Number 10. Grupo Aval, AVAL. Grupo Aval, based in Colombia, is a member of the worldwide banking sector. The holding company owns stakes in 4 of Colombia's most well-known banks, as well as a Central American banking franchise and other Colombian infrastructure and concession assets, such as toll roads. Over half of Colombia's export revenue comes from crude oil. As a result, the economy has struggled in recent years. Colombia, on the other hand, has surged back from the pandemic, with oil prices surging and the travel and tourism businesses exceeding 2019 levels of activity. Despite this, Aval is still about 30% lower than pre-pandemic levels, primarily due to the fact that many tourists are unaware that Colombia is recovering. This is the case, notwithstanding the company's recent report of record quarterly profits. Aval pays a monthly dividend of about 2.5 cents per share, or 30 cents per year, for a 5.5% dividend yield. Number 9. Westpac Banking Corporation, WBK. When it comes to international banks, Westpac appears to be a viable option. In the Australian banking industry, the company is a giant. The stock has plunged from $20 to $15 in recent months. This is partly due to China's economic weakening, which has affected the prices of important Australian commodity exports such as iron ore. Australia's economy is heavily influenced by inflation and global growth. In recent quarters, investors have begun to downplay inflation, focusing instead on rising interest rates and a slowing economy. If inflation becomes a serious issue again and commodity prices continue to climb, Westpac and other Australian banks might be able to recoup their recent losses. Australian banks, on the other hand, are known for paying out large dividends. WBK shares have a dividend yield of 6.2%. Number 8. New York Community Bancorp Incorporated, NYCB. For investors, New York Community Bancorp is a safe and higher-yielding bank. In the New York City metro area, the firm is a specialist regional bank that specializes in multifamily finance. The bank gives loans with a low loan-to-value ratio even during economic downturns, ensuring that it suffers few losses. New York Community Bancorp, for example, stayed profitable and paid its dividend during the financial crisis of 2008 to 2009. As New York City recovered from its pandemic-induced downturn in 2021, the bank's shares increased. A planned merger with Flagstar Bancorp Incorporated, FBC, was postponed, causing the stock to drop from $14 to $12.50. Because the bank pays a 5.6% dividend yield, this is a better entry point for income investors. Number 7. JP Morgan Chase & Company, JPM. It may appear that it is too late to invest in the next stock on our list of the top dividend stocks to buy in 2022. After all, JP Morgan stock has increased by about 25% in 2021 and is currently trading at all-time highs. However, don't overlook how much the country's largest bank's core business has grown during the same time period. Banks like JP Morgan are thriving thanks to a booming real estate market, increased stock market activity, and lower interest rates. Both the retail and investment banks are doing exceptionally well. Despite its huge increase, JP Morgan is still priced at just 10 times current year earnings. JP Morgan is all the more appealing because it is managed by the banking great Jamie Dimon. In addition, the stock pays a 2.5% dividend. Number 6. Raytheon Technologies Corporation, RTX. Raytheon is another prominent defense contractor. Raytheon was formed through a merger with United Technologies in its current form. After that, the firm was divided into other companies, including elevators and air conditioning. Raytheon's current concentration is exclusively on aeroplanes, drones, satellites, and cybersecurity. Due to the defense industry's recession, Raytheon's stock price has fallen far behind that of the S&P 500 as a whole. It's worth noting that Raytheon isn't just a defense contractor, it also has a large presence in the commercial aviation and space industries. Analysts expect double-digit earnings growth in the future, thus, the stock is presently priced at 17 times earnings. Furthermore, RTX stocks have a 2.4% yield. Number 5. Lockheed Martin Corporation, LMT. In 2021, the military industry had a dismal year. As a result of the Biden administration's decision to leave Afghanistan, investors sold off the sector. Despite this, Lockheed Martin continues to secure new government contracts in the United States and abroad, solidifying its position as one of the best dividend stocks to buy in 2022. Lockheed Martin was just given a $9.4 billion deal by Finland for 64 F-35 combat planes. The stock market, on the other hand, is still in a downward spiral. According to the environmental, social, and governance movement, many institutional investors are no longer prepared to buy companies that make weaponry. Ordinary investors have a lower entry point because institutions avoid military contractors. Lockheed Martin has a dividend yield of 3.2% and is valued at less than 13 times expected earnings. Number 4. Intel Corporation, INTC. No one considers technology firms to be dividend payers. There are exceptions, particularly among more advanced IT firms. Intel's large and stable semiconductor business for PCs and data centers is a cash cow. These aren't high-growth places, but they're steady and have profited from pandemic demand. Meanwhile, Intel has invested heavily in new, more futuristic businesses as a result of its large profits. Mobileye, for example, is a big motivator for 2022. Intel will spin out the company as a public company while keeping a majority stake. Analysts think that Mobileye is worth $50 billion or more on its own, a significant increase from Intel's $15.3 billion purchase price 4 years ago. Intel will lower its capital expenditures, freeing up funds to reinvest in its core business or return to shareholders. Intel now pays a 2.7% dividend. Number 3. Toyota Motor Corporation, TM. Most car stock traders have been focusing on EV enterprises in recent years. Given the bustle of activity and new product debuts in the EV market, this is understandable. Traditional automakers aren't going away anytime soon. Customers, dealers, and worldwide supply chains and logistical footprints all have a large footprint. Some even have better EV capabilities than others. One of the first truly successful hybrid vehicles was Toyota's Prius. Toyota announced last year that it would release 15 electric vehicles by 2025. It will also invest over $3 billion in battery manufacturing in the United States. Don't be fooled, Toyota will play a major role in the next generation of vehicles. The stock of the corporation is only worth 10 times its earnings. The stock also pays a dividend of 2.5%. Number 2. Enbridge Incorporated, ENB. The energy sector pays off for more than just oil and gas companies. Midstream companies are responsible for the storage, transportation, and distribution of crude oil, natural gas, and refined goods. Although Enbridge is not a household name in the United States, it is a blue-chip stock in Canada and the fourth largest position in the MSCI Canada ETF, EWC. Enbridge owns one of the largest pipeline networks in North America and has provided stockholders with stable dividends for decades. The company's payout has climbed considerably in recent years, notwithstanding the recent COVID-19 collapse. Pipelines, unlike oil and gas prices, are rather stable. Enbridge's dividend yield is 7.2%. Number 1. Exxon Mobil Corporation, ticker, XOM. The major oil and gas companies have had a trying 7 years. To stay afloat after the oil price plummeted in 2014, most energy companies had to reduce their dividends. Exxon Mobil was the one exception. Despite a temporary reduction in income, management kept their large pay package. Exxon Mobil also continued to make significant investments in new oil, gas, and refining projects. Exxon's offshore Guyana oil field, in particular, has established itself as one of the industry's most valuable new energy assets. Because it invested throughout the business cycle, while most of its competitors pulled back, Mobil is well positioned to benefit from the current spike in oil prices. The income appeal of Mobil, on the other hand, is as great as ever. Even if oil prices fall below zero in 2020, the dividend will be paid, and the stock yields 5.7%. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us. Dividend stocks to buy now.